Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, I'm going to tell you kind of a funny story. I started writing about gold and silver. I got involved in the precious metals space with another company. And this was probably 10, 11 years ago or so. And when the guys there initially approached me, I almost turned them down. I mulled over their offer for nearly a week. And do you know why I was reluctant? I didn't want to be that gold bug guy. I didn't want to get pigeonholed or stereotyped as the weirdo gold bug. Now, I'm sure you've heard that term, and obviously it's not meant to be a compliment. People who are interested in gold and silver are often stereotyped as, weirdo prepper kooks with, bunkers in their backyards. And I did not want to be perceived as that guy. And I was worried that it would maybe impact some of the other work I was doing. And I thought about it and talked to several friends, and fortunately, I ultimately didn't let that prospect deter me because, I'll be honest, I really enjoy the work. I think it's important work, and, what could be more important than trying to educate people and help people understand sound money and what the government is doing to their money? So I consider this a labor of love, and, every day, I have the opportunity to help people avoid one of the most destructive government actions that there is, the constant devaluation of your money that, in effect, steals your wealth. So, I guess at this point, if people want to call me a gold bug, well, I'll wear the label proudly. At least I'm not a fiat currency cockroach, right? And if I want to avoid that kind of smear altogether, I could just go to Asia. While a lot of people might look down upon me for talking about gold and being interested in gold here, it's kind of a weirdo minority outside the mainstream position in the United States. I'd probably be considered one of the smart guys over in, China or India or somewhere else over in Asia. And it's kind of weird. When you think about it, this negativity toward precious metals in the United States is kind of crazy. It's certainly not something that's rooted in the American DNA, the exact opposite, actually. Most of the founding generation was very wary of paper money. Thomas Paine wrote extensively about the dangers of paper money, but a lot of the founding generation spoke out against fiat paper. George Washington, Samuel Adams, Benjamin Franklin, many of the most important people in our founding generation. Thomas Jefferson may have summed it up the best. Paper is poverty. That is only the ghost of money and not money itself. So, it's so weird because, you fast forward 200 and some years and now all of a sudden, so many people in mainstream America are like, oh, gold is dumb. Gold is a relic, and it's just weird. But it is what it is, right? And I guess you have to give the political class credit because they have successfully soured the majority of Americans on real money. And of course, that's to the political class's benefit. It's to the benefit of government. They can print fiat money, and that's the engine that drives big government. So here's what I'm driving at. This anti-gold bias is a very Western phenomenon, and even more than that, almost an American phenomenon at this point. And you can see that in the demand for gold. This big rally that we've had over the last year and a half, where we've seen the price of gold, it's nearly doubled in price since 2022. Over the last year, that's happened by and large with American investors sitting on the sidelines. This momentum for this bull run in gold has come primarily from emerging market central banks and Eastern, particularly Asian investors. And, this isn't just something that I'm making up. It's not Mike Maharrey's supposition. It's backed up by the demand data. The strongest physical investment gold demand since 2013 is what helped push overall demand up a healthy 3% through the first half of 2025. But here in America, people were selling their gold to cash in on the higher prices. In other words, Americans are trading real money for depreciating fiat paper. I mean, I'm not brilliant or anything, but that doesn't seem like the smartest move in the world, now does it? So if we look at the gold demand for the first half of this year, if you include over-the-counter investment, so that's people, buying gold, physical gold, particularly over-the-counter, gold demand totaled 1,249 tons in H1. And this is all data that was compiled by the World Gold Council. So if we go back and look at the first half of the year, we saw a strong 26% price gain. And because the price of gold was increasing and there was also an increase in demand, the value of total gold demand surged by 45% year on year. It reached $132 billion through the first 6 months of the year. So let's kind of look at the gold demand a little bit, and we'll break it down into segments. And we'll start with central banks. Central bank gold buying has really been the steady support for the gold market for the last 3 years or so. And, it's kind of the foundation that this gold bull rally has built on. Central banks globally bought a net 166 tons of gold in the second quarter, and that brought the 2025 increase in global central bank gold reserves to 378 tons. Now, if you look at the data going back a few years, central bank purchases have slowed somewhat, and the second quarter actually charted the lowest level of central bank gold buying since the second quarter of 2022. However, it was still 41% above the quarterly level that was typical between 2010 and 2021. And we also saw some selling by central banks, such as Uzbekistan, and banks like that often shift between buying and selling, and that skewed the H1 numbers a little bit lower with the selling. So actually, gross buying was a little bit higher than those final statistics make it look, because you subtract the buying from the selling to get those final numbers. World Gold Council noted that while central banks typically buy gold strategically, they, quote, are not completely insensitive to its price level, right? So in other words, they tend to have a plan to build their gold reserves, but they do take into at least some consideration price. Quote, as such, gold's rally so far this year, up 26% to new record levels, has likely contributed to the slowdown in central bank buying. But that they continue to add gold in the face of a higher price underscores their continuing favorable attitudes towards gold as a strategic asset amid such uncertainty. If you look at the central bank statistics, the National Bank of Poland was the biggest buyer in the second quarter. It added another 19 tons of metal to its reserves, and that was on top of 49 additional tons that Poland bought in the first quarter. And so, that's kind of the central bank gold buying for the first half of the year in a nutshell. I will link to an article in the show notes page that goes into a little bit more detail, and you can see all of the banks that actually bought and sold and how much. And that'll be over at moneymetals.com/news. So while central bank buying ebbed somewhat last quarter, investment demand took up the slack, and it increased everywhere but America. If we look at total investment demand, it was up 78% year on year in the second quarter. We had significant positive flows into gold-backed ETFs and a healthy growth in both bar and coin demand. So these two segments kind of contributed to the big pickup in investment demand. Bar and coin demand was up by 11% in the first half of the year. 582 tons of gold bars and coins were purchased globally. And of course, Chinese and Indian investors led the way in that big increase. Chinese bar and coin demand in particular grew by 44% year on year in half one. Chinese investors snapped up 115 tons of gold bars and coins in the second quarter alone. That was the strongest first half for physical gold buying since 2013 in China. India bar and coin demand also grew by 7% through the first half of the year. So that's really where the foundation of your physical gold buying is going on. China, India, and then also other Asian nations. You can look at South Korea, Vietnam, Taiwan, Thailand, all of these countries. They love gold and they are piling into it right now. So if we go a little closer to home, bar and coin demand actually also grew in Europe, albeit at a slower pace than Asia. Overall physical investment demand in the EU was up 6%, and second quarter bar and coin demand more than doubled to 28 tons. Now, that looks a little better than it actually is because it's coming off of a very low base. In the early part of the gold bull run, going back into last year, Europe was kind of lagging behind along with the United States. But Europe has started to wake up over the last several months, and we're starting to see physical gold demand pick up over there. And as I've already pointed out, Americans continue to sell their gold. Year on year, bar and coin sales plummeted by 53% in the first half of the year. Demand in the second quarter was only 9 tons in the U.S. Now think about that. When I say Chinese, they snapped up 115 tons of gold bars and coins in the second quarter, and in the U.S., there was only 9. So you can really see the disparity there. This 9 tons in Q2 in the U.S. was the lowest quarterly level since the fourth quarter of 2019. If we look at the World Gold Council analysis, they said, quote, U.S. net investor demand was again affected by a double whammy of elevated profit-taking and subdued levels of new purchases. So as I've already said, so many Americans are looking, the price of gold has gone way up. Let's sell our gold and get some devaluing paper currency. I mean, and I get it. You know, there's a lot of stress on American consumers right now. And it's interesting because I wrote an article yesterday. I'll link to it in the show notes page. If you look at the data, if you look at Wall Street, things seem really good, right? We're seeing new stock market highs week after week after week. And yet people are stressed out on Main Street, and Legal Shield does this consumer stress index, and it's at the highest level since the pandemic right now. And it's primarily because Americans are just drowning in debt, credit card debt, consumer debt, piled up high, and people are starting to struggle to pay those bills. So, you know, maybe that's part of what we're seeing here. People are cashing out their gold and silver, trying to make ends meet because of the persistent price inflation. But barring that, you know, obviously in an emergency, if you got to pay some bills, then you got to do what you got to do. But to trade real money, to trade gold and silver for paper fiat is dumb unless it's just absolutely necessary. Anyway, if we look at gold ETF investment, now it was stronger in North America. And when Americans are investing in gold, they tend to be doing it through ETFs as opposed to buying physical gold and coins. The funds in the North American region added 73 tons of gold in the second quarter. However, Asian ETFs did even better, nearly matching their North American peers, even though their collective holdings are about 1/5 of the size. Asian listed funds reported 70 tons of gold inflows, so just 3 tons less than what we saw in North America. In total, gold ETFs globally reported 170 tons of gold inflows in Q2. That's a pretty significant number, and that drove the first half of the year total to 397 tons. It was the strongest semi-annual performance since the record-breaking 734 tons that we saw in the first half of 2020 at the outset of the pandemic. So, according to the World Gold Council, quote, uncertain global trade policy, geopolitical turbulence, and the rising price of gold all fueled inflows of gold into ETFs. Now, keep in mind that ETFs are a convenient way for investors to play gold on the market, right? These are just funds. They are backed by physical gold, typically, and they trade on the stock market, just like a regular stock. So it gives you exposure to the price of gold, but you're not actually holding the gold. But keep this in mind as well. Owning ETF shares is not the same as holding physical gold. There's a difference in investing in an ETF and in investing in gold. Primarily counterparty risk. When you invest in an ETF, you are taking on the counterparty risk of whoever's managing that fund. When you hold physical gold and silver in your own hands, you are eliminating that counterparty risk. So, I'm not saying that ETFs are a bad thing, but I would just want to remind folks that they are different investments. And in my never to be humble opinion, I think that you should expose yourself to physical gold first, and then ETFs can be a way to kind of add to that portfolio and maybe place some of the short-term movements of the metals if that's something that you are inclined to do. So anyway, more generally, according to the World Gold Council, anecdotal reports suggest that institutional investment remained healthy with continued interest in global high net worth investors. So a lot of people that have a lot of money are investing in gold is what that sentence by the World Gold Council means. So institutional investment is healthy. There's a lot of high net worth folks that are looking at gold, and this is helping to buoy the nice gold bull rally that we've been in for the last 18 months or so. While the higher prices have boosted gold investment demand, though, it has created significant headwinds for the jewelry market, and that's another big segment of demand for gold. Second quarter gold jewelry demand fell by 14% year on year. There was 341 tons of gold that was committed to jewelry. It was the lowest quarterly total since the third quarter of 2020. Quarterly demand for gold jewelry was 30% below the 5-year quarterly average of 487 tons. Makes sense, right? I mean, jewelry is kind of a luxury item, especially here in the West. Now, if you go to Asia, India, and China, they do view gold jewelry more of it as an investment. And a lot of their gold jewelry, gold chains, and things like that are of a higher purity, right? Here in the United States, you'll typically see 14 karat gold, maybe 18 karat gold. If you go to Europe, you'll get closer to 22 karat gold, closer to pure, and it is considered more of an investment. So it is part of kind of the investment, especially in rural areas of like India. However, still, for a lot of people, jewelry is kind of a luxury item. So it makes sense that as the price goes up, you're going to see a drop in demand. Kind of breaking it down, 17% dip in jewelry demand in India and a 20% drop in China drove the overall market lower. China and India's combined market share actually fell below 50% of the global total for only the third time in the last 5 years. The only market that reported an increase in gold jewelry demand was Iran, which is interesting. It was likely driven by safe haven investment jewelry demand in the wake of Israel's attack on the country's nuclear program. But you can kind of see how in a lot of Asian countries and in the Middle East, gold is considered, a safe haven, whether in the form of coins, bars, or high purity gold jewelry. Looking at another segment of gold demand, kind of the last little piece of the puzzle, gold used in technology and industry charted a modest 2% decline in the second quarter. And again, kind of makes sense given the economic turmoil and the issue with tariffs. Tech industrial gold demand was 78.6 tons in the second quarter, and that was down slightly from 80.2 tons in the first quarter. And that was primarily driven by a 2% drop in the amount of gold used in electronics. Again, a lot of turmoil in the electronics market globally. They're trying to figure out their supply chains and how to deal with the new trade arrangements. So, this makes sense. According to the World Gold Council, the tariff situation has caused significant uncertainty in the electronics sector, impacting output. Quote, many East Asian manufacturers continued to front-load orders ahead of potential tariffs, and in parallel, they made significant changes to their supply chain strategies. Challenges remain in the form of export restrictions to China, with companies such as Samsung reporting significantly weakened operating profits during the quarter as a result. Other industrial and decorative gold use, which is primarily gold plating, gold thread that's used in traditional India clothing, that fell 3% annually to 11 tons in Q2. According to the World Gold Council, quote, China's fragile economic climate has undermined demand in the luxury and plating industries. And then, of course, also the headwinds created by higher prices. So if we're looking ahead, gold demand, there really isn't any reason to think that demand is going to ease anytime soon, right? With the employment situation suddenly looking much more bleak, and I'm going to get to that jobs report here in just a minute, it looks like the Fed will have the excuse it needs to cut interest rates. I think that most analysts are now thinking that, a September rate cut is far more likely than it was a few weeks ago. And this will likely further weaken the dollar, and it's going to likely give gold yet another boost. And don't sleep on silver. After a healthy rally where silver touched $40 an ounce, we're kind of in a consolidation phase right now. This morning, we're trading right at $38 an ounce. However, the fundamentals and the technicals both signal plenty of additional upside for silver. I'll give you just one example, this gold-silver ratio. I looked at it yesterday. It's back to 89-1, which signals that silver is still significantly underpriced compared to gold, at least from a historical perspective. And historically, when we've seen these wide spreads in that gold-silver ratio, it's typically snapped back to closer to the historical average, which is around 60-1. And when that snapback happens, it usually happens relatively quickly, and it generally happens at the in the later stages of a gold bull rally. Silver tends to lag gold, but silver often outperforms gold in a gold bull rally. So we still haven't seen that dynamic come to pass. If you're interested in a more in-depth look at the silver market, make sure to tune into our Friday podcast. I've already interviewed Peter Kraut for that show. He's one of the top silver analysts out there, and we talk about why silver tends to lag behind gold in a gold bull market and why he thinks silver is on track to hit new records in the relatively near future. So we're talking about $50 plus silver. And with that in mind, Money Metals has a great way for you to get started in investing in silver. We have a 9-piece silver starter set, and it includes an American 1-ounce silver eagle coin, a 1-ounce Canadian silver maple leaf coin, a walking Liberty 1-ounce round, a walking Liberty half-ounce round, and a walking Liberty 1/10 of an ounce round. 5 of those. And right now, Money Metals is running a first-time buyers special. You can get a below spot American Silver Eagle. And if you pair it with the starter kit, you'll get the coins and rounds at a lower cost, plus free shipping. And as a bonus, you'll get coupons for future savings. It's a great deal. And, it's just in time to take advantage of what could be a significant increase in the price of silver as we move forward. Like I said, the technicals and the fundamentals both still look really positive for silver. So there's still an opportunity to get in. This is a great way to do it. And you can call the folks over at Money Metals, talk to a precious metal specialist that can give you more details about this special deal. So, I mentioned the July jobs report. Man, what a fiasco that was, right? President Donald Trump made headlines when he fired Bureau of Labor Statistics Commissioner Erica McIntyre. I think that's how you say it, McIntyre. After a particularly bad July jobs report, Trump called the numbers rigged. And, the president isn't wrong. I mean, I've been saying the numbers are rigged for a long time. I was talking about this back during the Biden administration. In fact, significant downward revisions to those initial job numbers have been the norm for years. If you look at the July BLS report, and you've probably heard this, but I'll just quickly go through the numbers. The U.S. economy added only 73,000 jobs in July, and that was significantly lower than the 110,000 that was forecast. And we also saw the unemployment rate notch up just a tad to 4.2%. Now, that was bad enough, right? It missed the beat. It's a low number, but the downward revisions of the data from the previous 2 months, that was what was really eye-popping. Listen to this. The number of jobs created, and I'm using air quotes around created because they weren't created at all, they were made up. Those May numbers were revised down from 144,000 jobs initially reported created to 19,000. And then we go to June. The number of new jobs, again, using air quotes, dropped from 147,000 to a mere 14,000. Like I said, I kind of watch these numbers and I do pay attention to the revisions. I can't remember when I've seen revisions this significant. In total, the BLS erased 258,000 jobs. Basically with a few computer strokes, oh, sorry, we made a mistake. And of course, as I mentioned, Trump called the numbers rigged. And he said in a post on Truth Social, quote, "They were rigged to make the Republicans and me look bad." So he fired the commissioner, and who was incidentally a Biden appointee. And when asked why he did that, he said he wants people that he can trust in these positions. Now, I don't know whether McIntyre cooked the books to make Trump look bad, if that was her intention. But there is plenty of evidence that the books are cooked and that they've been cooked for a long time, and that this data has either intentionally or by gross incompetence made it look like there were a lot more jobs being created than there were. And that's been going on for a long time. The BLS has a long history of reporting these rosy job numbers and then quietly coming back, behind the news reports and then revising them downward. I'll just give you an example. In 2023, the job numbers were revised downward from the initial report in 10 out of the 12 months. So we had 10 months in 2023 where the initial reports that we got, on the first Friday of the month, those reports were better than what the actual numbers ended up being. If we look back over a longer term time, it's clear that the revisions have always been part of this process, right? The thing that strikes me, though, is that the revisions are almost always down. If you go back to 2003, the final job numbers were lower than the initial report 14 times in those years compared to only 7 upward revisions. I mean, it's almost as if the agency is trying to make the government look good. And, when you look at this history, you have to wonder, why does anybody ever take these numbers at face value? And yet they do, right? Every first Friday of the month, everybody's waiting with bated breath. What are the job numbers going to be? And then when those job numbers come out, you watch the markets. They go up or down based on these numbers. And the numbers are always wrong. Now, if you want to be fair, reasonable, a good guy, you could argue that calculating job data is a difficult process. I'm sure it is. And that revisions are to be expected. And I accept that argument. I've also seen that there's a much lower response rate in recent years to these surveys. These job numbers are based on surveys. It's not like they're actually going out and counting literal jobs. They survey people, they make extrapolations, they use formulas, and they come up with the numbers. So, let's be honest, it's basically made up. It might be a mildly informative makeup, but they are effectively made up. But I do accept the argument that it's difficult to calculate this data. But when the error almost always occurs in the government's favor, you gotta wonder, right? If the BLS were making honest mistakes each month, you would think that sometimes they would underestimate the number of jobs created, right? But they almost always overestimate the numbers. They almost always say there's more jobs than there actually were, and then they revise it down. If you flipped a coin and it came up heads, 10 out of 12 times, you would probably start to wonder about the integrity of the coin, wouldn't you? You'd at least frown, right? You would think something might be suspect with that kind of odds. And By the way, the job numbers aren't the only sketchy data that's pumped out by government agencies. I've argued for years that the CPA data grossly underestimates price inflation. And we know that this is on purpose because the government literally changed the formula back in the 1990s to understate the actual rise in prices, right? In the 70s, they used a different formula. And in the 90s, they thought, well, this is showing a lot of inflation. Maybe we ought to look at this formula. And so they changed the formula. And so now the formula shows price increases being less than what they would show if you were using that older formula. If you use the formula that they had in the 1970s, and I'm not going to say that that was greatly accurate either, but if you use the 1970s formula, CPI is closer to double the official numbers. So if the BLS used the old formula, we'd be looking at CPI, today closer to 8%. And if they were using a truly honest formula, it probably would be even worse than that, right? Now, you might be thinking, well, yeah, Mike, okay, we get it. Jobs data is bad, government lies, duh. What's the big deal? Well, the problem with disingenuous jobs data is that very few people pay attention to the revisions, but they pay a lot of attention to those initial reports. Now, this month was kind of an exception because obviously the revisions were just too big to ignore. And then you had the president, firing the head of an agency. So yeah, it made headlines. But typically, you don't hear reporting on those revisions. So what happens is the markets only react to the initial numbers, right? You never see the markets rally because the BLS erased a bunch of jobs from the economy with a few clicks of the calculator. The revisions happen quietly, like in back alleys somewhere, right? Nobody pays attention to them. This creates the illusion that the labor market is much stronger than it actually is. So why should we trust any of these numbers, much less make decisions based on these numbers? Again, it's really important to wrap your head around the pattern here, right? This month, the government reports good news, everybody celebrates, markets move up, and then the next month, the government quietly comes behind, revises everything downward, and reports that the good news was really bad news. But nobody pays attention to that, right? There's no headlines about that. There's no, Friday, we're going to get the job revisions. No, nobody pays attention. So my point here is it might be a good idea to pay attention to the revisions too. And this is true no matter who is running the BLS. So all of this underscores a very important point. The fact of the matter is the economy isn't nearly as rosy as the headlines indicate. The headlines need revisions to go along with the data revisions, right? So where is all of this going? Well, the mainstream has taken this sudden job reversal, or I guess it would be more accurate to say the awareness of this job reversal, as a signal that the Federal Reserve will probably go ahead and cut interest rates sooner rather than later. After all, price inflation is basically under control, right? Or is it? Right? Don't forget that the CPI data is just as unreliable as the jobs data. Price inflation is higher than they're telling you. And they've been expanding the money supply for over a year, which is by definition inflation, right? They're inflating now. We're not seeing it so much in prices, although there have been some heating up of CPI. But where you really see the inflation is in the money creation, because that is the inflation. The rising prices follow the increase in the money supply. And now they're talking about ramping up the inflation machine even more, right? Lower interest rates are inherently inflationary. It stimulates and incentivizes more borrowing, and borrowing in a fractional reserve banking system expands the money supply. This sounds like a recipe for more devaluation of your money. And this is exactly why you want to have real money. And this is why I keep saying every single week, now is the time to talk to a money metals, precious metals specialist call 800-800-1865. Talk to one of them today. I've already mentioned that we have this special deal going on with our silver investment starter kit. So you can ask about that, get more information on that. These folks are fantastic. They're very knowledgeable. They can help you figure out how precious metals can fit into your investment portfolio. If you're interested in gold and silver in an IRA, they can talk to you about that. We have a monthly program where you can build a gold and or silver portfolio over time using as little as $100 a month. So make that phone call today. Now, I know a lot of folks don't really like to talk on the phone. You can go to moneymetals.com. You can chat with the precious metals specialist right online in a chat. Or if you know what you want to buy, just go to moneymetals.com, search the products, find what you want, order it, we'll ship it to you, and you'll be adding to your wealth and preserving your wealth and stocking up on real money instead of fiat. Don't be like so many of these Americans that are trading in their real money for devaluing paper. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about all of the things that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Again, I say this every week, but thank you so much for listening to the show. I really do appreciate it. I know there's a lot of choices out there. Thank you for spending a little bit of time with me each and every week. If you like the show, please do us a favor. Give us a good review on your podcasting platform. Crush those like buttons. Share the episode. It helps grow the show. That's all we ask of you, our dear audience, and we really do appreciate that. So, again, thank you so much. Have a fantastic rest of your week, and I'll be back again next Wednesday.